Look at the price of silver on your screen right now. Go ahead. Open your brokerage application on your phone. Look at that little digital line moving up and down. Here is the thing. Whatever number you are looking at is a complete illusion. And no, I am not wearing a tinfoil hat. And I am not about to pitch you some wild internet conspiracy theory about a secret society hiding all the gold and silver in a hollowed-out mountain. I am saying this because the math is sitting right in front of us, fully verifiable, and the mainstream financial media is currently too busy hyperventilating over the latest tech stock rally to bother reading a simple warehouse report. We have been here before. Think back to 1929, or the summer of 2008. Right before the bottom fell out of the global economy, the experts on the television were looking straight into the camera, wearing their expensive suits, telling everyone the banking system was fundamentally sound. They always do. It is their job to keep the music playing while the smart money quietly heads for the exits. Money, as we know it today, is largely a shared hallucination. But physical assets, things you can hold in your hand, those are real. What is happening in the silver market right now is the exact same playbook from past financial crises, just with a different asset and a different distraction. Here is what most people do not realize. For 18 straight months, someone has been standing for physical delivery of silver at the COMEX exchange in quantities that have absolutely never been seen in the history of that institution. They are not rolling their paper contracts forward to the next month like normal day traders. They are not settling in cash. They are backing up literal armored trucks, loading up billions of dollars worth of real physical silver and driving away from the vaults of Manhattan. Since October of 2025, the total COMEX silver inventory has declined by a staggering 31%. Let us do some simple math to really understand the gravity of this situation. The registered pool, which is the actual physical metal immediately available to back up the paper contracts that everyday people trade, has plummeted. The coverage ratio currently sits at a catastrophic 13.4%. Imagine a local bank that only keeps 13 cents in the vault for every single dollar you and your neighbors deposit. Now imagine the bank teller smiling at you, handing you a complimentary lollipop, and telling the world on live television that your life savings are perfectly safe. That is the COMEX silver market today. It is a massive game of financial musical chairs, and the music is slowing down. Please, stay with me here. Do not scroll away. Do not leave, because this next part is where it gets really interesting, and it directly affects your financial future. Now, you might be thinking, well, if there is a massive global shortage of the physical metal, why is the price not skyrocketing right now? Why did silver crash so violently earlier this year? That is the ultimate psychological trap. Human beings are biologically wired to trust what they see on a glowing rectangle. If the red candle on your chart goes down, you feel fear in your stomach. But the people who actually run the global economy do not look at daily red candles. They look at physical supply chains. Let me take you back to January 29th, 2026. Silver was sitting at an all-time high of $121.64. The very next day, the White House announced that Kevin Warsh was nominated to replace Jerome Powell as the chair of the Federal Reserve. What followed was a 31% drop in a single session. It was the worst one-day crash since 1980, dragging silver all the way down to the $74 level where it sits today. Why did one single nomination announcement cause that? Silver is a non-yielding asset. When interest rates are high, money parks in government bonds. Warsh built his reputation as an inflation hawk. The market immediately assumed he would keep interest rates elevated, so they panicked. But that headline was just the match that lit the powder keg. The paper market was actively weaponized to create a manufactured panic. Between December and January, margin requirements for silver futures at the COMEX were suddenly hiked by approximately 300% in a tiny 6-week window. If you held 50 contracts, your margin requirement skyrocketed from $750,000 to $2.7 million just to keep your existing position open. If you were an average retail trader and you could not fund that massive margin call, your broker liquidated your position automatically. Combine that engineered margin crush with the mechanical, legally mandated selling of January exchange-traded fund rebalancing, and you get a massive structural flush in the paper price. Western retail investors panicked and sold everything because a red line on a screen terrified them. Meanwhile, who was buying? Enter the Eastern elephant in the room. In 2025, China was a net exporter of silver. Fast forward to January of 2026, and they abruptly reclassify silver as a strategic material. In March of 2026 alone, China imported 836 tons of silver. That is almost 3 times their 10-year seasonal average. And here is the kicker. Chinese buyers are paying a massive premium, roughly 12 to 17% above the international benchmark, just to get their hands on physical silver. The well-funded sovereign buyers looked at the artificially discounted paper price caused by the Kevin Warsh panic, quietly said thank you, bought the dip, and loaded up more trucks. They shook the weak hands out of the market so they could buy hard assets for pennies on the dollar. If you want to understand exactly how this engineered wealth transfer works and how you can position your own portfolio before the final trap closes, hit that subscribe button right now. If the underlying fundamentals are screaming for a massive breakout, why does the daily chart still look like a descending staircase? This is where it gets really interesting, so please, do not click away just yet. If you are watching that daily chart and feeling that knot of anxiety in your stomach, you are simply looking at the wrong map. Staring at daily price action is for amateurs drawing lines with crayons. What we have been experiencing for the past few months is not a true downtrend. It is a violent congestion zone driven by pure uncertainty. The market is completely paralyzed right now because no one actually knows if Kevin Warsh is going to act like a hawk or a dove when he takes over. But that ambiguity has a strict expiration date. That date is May 15th. That is the exact day Jerome Powell leaves and Warsh officially takes the chair. 3 days before that, on May 12th, we get a massive consumer price index inflation report. When that uncertainty finally resolves, this market is going to move violently. So, what is the exact signal that the smart money is back in control? Let us talk about momentum. Veteran technical analyst Michael Oliver, a man who has spent 40 years accurately predicting major market reversals, does not care about the daily noise. He looks at structural momentum. Oliver identified one specific number that triggers what he calls a historic upside breakout. That number is $80. But not just $80 on a random Tuesday afternoon. It has to be an $80 weekly close. Why is an $80 weekly close the magic number? Because that is the exact line in the sand where three completely independent, massive technical structures simultaneously flip from negative to positive. You have the weekly momentum oscillator, the 10-week average oscillator, and the simple weekly price chart all converging at that exact same zone. When a major asset breaks out of a multi-month consolidation pattern at a level where every technical system flips positive, the resulting move is almost never small. Every trader who has been betting against silver suddenly faces massive losses and has to buy to cover their positions. Look, by the time the May 15th transition happens and the broader market wakes up, the easiest entry points will already be long gone. The institutional money knows this. They are positioned for it before the confirmation even arrives. They are quietly accumulating real wealth while you are getting kicked in the shins by daily volatility. If you want to know exactly where all this displaced capital is about to flow when the traditional stock and bond markets finally crack, you need to hear this final piece of the puzzle. Let us take a step back and look at the terrifying macroeconomic picture that is forcing this massive displacement of capital. To understand why the smartest money on earth is quietly hiding in physical metals, you have to look directly at the burning building they are sprinting away from. That burning building is the United States Treasury market. In the fiscal year of 2024, the United States government spent $1.13 trillion strictly on the interest payments for the national debt. That is not paying down a single penny of the principal. Total defense spending in that exact same year was only $954 billion. For the first time in American history, we spent more money servicing past financial sins than protecting our own borders. Historians call this Ferguson's Law. It is the unyielding mathematical principle that any world power that spends more on debt service than on its own defense is on the absolute brink of ceasing to be a great power. Former Treasury secretaries are now publicly begging authorities to draft emergency contingency plans because they fear a total collapse in demand for government bonds. For the last 40 years, Wall Street has aggressively sold the middle class on the 60-40 portfolio. 60% in stocks for growth, 40% in government bonds for safety. But what happens when the bonds are no longer safe? We are currently sitting at the dizzying peak of the most massive stock market bubble in human history. When the current market inevitably tops out, and government bonds simultaneously start acting like toxic waste, the traditional models completely break down. Bonds used to offer risk-free return. Today, they offer return-free risk. When both pillars crumble, trillions of dollars of institutional capital are suddenly trapped. That frightened capital cannot go into digital illusions like cryptocurrency, which is facing its own structural wipeout. It cannot stay in paper currencies that are actively being inflated away. It has no choice but to flow into hard, tangible reality, gold, and most importantly, silver. This is where the mathematical setup gets genuinely staggering. Why choose silver over gold? Let us look at the historical gold to silver ratio. During the massive bull market of 1980, silver reached roughly 6.5% of the price of an ounce of gold. In 2011, it reached 3.1%. Today, silver is sitting at a pathetic 1.6%. It is historically mispriced to an absurd degree. If that ratio simply reverts back to the 2011 level, silver mathematically doubles relative to gold. If gold launches into a multi-year rally because central banks are forced to print trillions just to save the dying bond market, silver acts as a leveraged slingshot. It will likely appreciate twice as fast, with veteran analysts pointing to targets of $300 to $500 an ounce. Wayne Gretzky famously said, "I always skate to where the puck is going, never to where the puck is." The paper price on your phone, the Kevin Warsh headline panic, the daily red candles, that is where the puck is right now. The relentless physical delivery data, the massive sovereign hoarding by nations like China, and a global debt crisis with absolutely no mathematical exit strategy, that is where the puck is going. By the time the breakout is painfully obvious to the general public, the massive transfer of wealth will have already taken place. Reality will violently reassert itself. If you want to stay ahead of this historic wealth transfer and protect your family from the coming financial storm, hit the like button, subscribe to the channel, and turn on notifications so you never miss an update.